You've probably heard some version of this. AI is different. These companies are printing cash. This isn't the dot-com bubble. Here's the thing about that story. It's only half true. Yes, Microsoft, Meta, Google, they're profitable, genuinely. But the actual build-out, the data centers, the GPUs, the power plants, that's not being paid for the way you think. A huge chunk of it is debt, and some of that debt is flowing through a financing structure so circular, so self-referential, that even the people running it have started publicly worrying about it. Today, we follow the money, all the way down. Let's start with something almost nobody questions. For years, big tech funded itself, cash flow in, capex out, no drama. Apple, Microsoft, Google, these companies used to sit on so much cash that the phrase too much cash was an actual criticism analysts made. That era is over. AI infrastructure spending has gotten so massive. Data centers, chips, power infrastructure, that even the most profitable companies on earth can't fund it purely out of operating cash flow anymore. According to the Bank for International Settlements, in its June 2026 annual economic report, free cash flows at these firms have started lagging capital expenditures in absolute dollar terms. That's a first. So where's the rest coming from? Debt markets, all of them. Investment-grade bonds, junk bonds, private credit, asset-backed securitization, every lane on the highway, at the same time. Now here's where it gets genuinely strange. A lot of this AI build-out isn't financed directly on the tech giant's own balance sheet. Instead, companies set up something called an SPV, a special purpose vehicle. Think of it as a separate legal shell company, deliberately built to be bankruptcy remote, meaning if things go wrong, its debts are ring-fenced away from the parent company. Meta did this with its Hyperion data center campus in Louisiana. A $30 billion deal, the largest private credit data center transaction on record. Meta created an SPV called Bainut Investor, owned about 20% by Meta and 80% by Blue Owl Capital and other private credit lenders. Meta then pays that SPV rent to use the facility. On Meta's own balance sheet, no debt showing up, just a lease expense. Oracle did something similar for its OpenAI-linked facility in Abilene, Texas, roughly $13 billion structured through Blue Owl and alongside separate, multi-billion-dollar debt packages for sites in Wisconsin and New Mexico. Here's the analogy. Imagine Andy, same Andy from private credit, except now Andy's rich uncle needs a house built, but doesn't want the mortgage showing up on his own credit report. So Andy sets up a shell company. The shell company takes out the mortgage, and Andy's uncle just pays rent to the shell company he secretly owns most of. Technically not his debt, functionally, absolutely his debt. But this is just the warm-up. Here's the part that should actually make you sit up. Nvidia has committed up to $100 billion into OpenAI. OpenAI, in turn, uses a huge portion of that money to buy, you guessed it, Nvidia chips. The cash doesn't really leave the building. It goes out one door and back into another, showing up on Nvidia's books as revenue growth. This is called circular financing, and it has a very specific, very uncomfortable historical parallel. Back in the late 1990s, telecom equipment makers like Nortel and Lucent did something eerily similar. They lent money to their own customers, who then used that borrowed money to buy Nortel and Lucent's equipment. Revenue looked incredible, growth charts, vertical. Investors cheered. Then customers started defaulting, the loans turned out to be worthless. And the revenue those loans had generated evaporated overnight, dragging Nortel into one of the largest corporate bankruptcies in Canadian history. According to the BIS's own June 2026 report, regulators are now explicitly naming this pattern. Private credit loans to AI-related companies grew from roughly $3 billion in 2010 to over $40 billion originated in 2025 alone, with outstanding AI-linked private credit exposure surging past $200 billion. Morgan Stanley projects an additional $800 billion in data center financing from private credit over just the next 2 years. And this isn't some fringe theory. In January 2026, U.S. senators sent an open letter to regulators, warning that the AI sector's growing reliance on complex and opaque debt markets could trigger destabilizing losses across financial institutions. Oracle, one of the companies at the center of this build-out, has seen its 5-year credit default swap spread jump roughly 310%, pushing its perceived credit risk to a 16-year high. Both S&P and Moody's have placed Oracle on negative credit watch. By January 2026, and was reportedly struggling to find enough investors willing to participate in syndicating Oracle's Stargate-related debt. Even the people building this are saying the quiet part out loud. Meta's own CEO has publicly acknowledged that misspending a couple $100 billion would be very unfortunate. OpenAI CEO has made similarly cautious remarks about the pace of spending. When the executives running the boom start hedging in public, that's not nothing. There's also what analysts are now calling the GPU debt treadmill. Data centers are financed as if they'll generate stable returns for decades. But GPUs, the actual chips doing the AI computation, have a useful life of roughly 7 years before they're outdated. So you've got 30-year debt structures backed by assets that depreciate in about a quarter of that time. So who's really financing the AI bubble? Not just Nvidia. Not just the hyperscalers writing checks from their own cash reserves. It's private credit funds - Blackstone, Blue Owl, Apollo, PIMCO, BlackRock, channeling money that ultimately traces back to pension funds, insurance companies, and institutional investors. The same category of investors we talked about with the broader private credit story. And because so much of this debt sits inside off-balance sheet SPVs, the leverage doesn't show up cleanly on any single company's books. To BIS itself put it plainly, these financing structures might mask leverage by moving it off the balance sheet, but leverage doesn't actually disappear just because it's harder to see. Follow the incentive again. Tech companies get to keep their balance sheets looking clean. Private credit funds collect enormous fees managing these deals. Chip makers get to book circular transactions as genuine revenue growth. Everyone directly in the deal has a reason to keep the story simple. AI companies are just really profitable. To people who don't have that incentive. The pension holder who doesn't know their fund has exposure to a Louisiana data center SPV. The insurer quietly stress-testing policies against a boom that insurance brokers themselves are now calling unprecedented in scale and opacity. This is also why you rarely see this explained clearly. AI stocks hit new highs is an easy headline. Clean chart, clean story, 5 seconds to understand. A hyperscaler created a bankruptcy remote special purpose vehicle owned by a private credit fund to keep $30 billion in data center debt off its balance sheet, while Nvidia's equity stake in a customer generates revenue that flows back through GPU purchases. That doesn't fit a headline, it barely fits a paragraph. So instead, most coverage sticks to the surface level story. Strong earnings, blue-chip balance sheets. This isn't like the dot-com bubble, all true, as far as it goes. But it skips the layer underneath. The layer regulators, credit rating agencies, and now even central bank economists at the BIS are actively flagging as a genuine systemic risk. So, back to the question we started with. Who's actually financing the AI bubble? It's not a simple answer, and that's exactly the point. It's hyperscalers, yes, but increasingly through debt, not cash. It's private credit funds, quietly becoming some of the most important lenders in the entire tech sector. And it's a circular flow of money between chip makers and their own customers that looks a lot like revenue growth, until it doesn't. I'm not telling you AI is a scam, and I'm not telling you to sell your tech stocks tomorrow. I'm telling you, the next time someone says these companies are just too profitable to fail, ask them how much of that profit is actually cash, and how much of it is a loan that hasn't come due yet. Check the structure behind the headline. Ask who benefits from the story staying simple. If this made you look at your AI stock holdings a little differently, subscribe, because we're going to keep tracing exactly where this money actually goes. And drop your take in the comments. Do you think this circular financing unwinds quietly, or does it end the way Nortel did? See you in the next one.